You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now I'm pleased to introduce our first session, The State of the Industry. This annual deep dive into trading and market trends features a twist this year, a panel discussion on where we stand today. It's my pleasure to welcome Henry Schwartz, Senior Director and Head of Product Intelligence for SIBO Global Markets. Henry?
Good morning. Thank you for having me. Welcome, everybody. And I'm happy to be here. And thank you to OIC for putting this together. I was pretty bummed out last year when things were canceled for good reason. And I certainly hope that next year we are all in some warm place hanging out by the pool for part of the conference. As they said, this year I'm going to do State of the Industry slide deck, which I've done for the past 5 or 6 years. But this year it's better because the format's changing a little bit. I'm still going to cram through way too many slides in about 15 minutes. And then we have a panel of 3 legends in the industry to go to, which is awesome because I did the math. We have 120 years of experience in the equity derivative space between the 4 of us. So I'm going to introduce that panel. Then I'm going to run through the slides. Then we go to the panel, and hopefully they're going to be able to shed additional light on what's going on and tell me what I screwed up. On the panel today, we have Annabelle Baldwin, who is Chief Revenue Officer at SpiderRock. There she is. Hi, Annabelle. Hi. SpiderRock is one of the most highly regarded execution brokers, especially in the quantitative space for equity derivatives. Annabelle has it's funny, I've known all of these people for 15 plus years. Annabelle also has time at CBOE back in the day, and TD Ameritrade, a few other places too. So a great depth of knowledge, and we're happy to have her.
Thank you.
Second up, we have Shelley Brown from Miami Holdings. Shelley is the Executive Vice President, Strategic Planning and Operations at MIAX. Shelley is a legend in the business. He's been, I've known his name for at least 20 years. Philly, NASDAQ. I didn't even realize he was at Susquehanna way back as well. So that's very exciting, particularly because MIAX is the new kid on the block in terms of our market structure. So welcome, Shelley. And last up is Jim Hyde, who said he didn't need an intro because he's so well known. I'm still going to introduce him. Jim is the Senior Director at Intercontinental Exchange, the Head of Business Development for NYSE Options, which is Amex and ARCA options exchanges. Jim just mentioned he's been there for 30 years, so that's a ton of experience. And Jim is also president of STANY, which is Securities Traders Association of New York, and also secretary of the STA, which is the National Association of Securities Traders. So welcome, Jim Hyde. Okay, we're going to get into slides. And I will go fast because I want as much time as possible for the panelists. Now, OIC asked me to concentrate on recent history, but this slide does not do that. This slide is the forever history of listed options in the American markets, going back to 1973 when SIBO first listed contracts, calls only at the beginning. And what I want to point out here is that a relatively quiet kind of start to things, barely even a couple 100 million contracts a year until around the year 2000. Now, I have an older version of this slide which had exchange logos all over it, but it's important to keep in mind as this volume is growing that the exchange landscape is growing. So there were 4 exchanges, the 4 floor exchanges, the SIBO, the Philly, Amex, and ARCA, which was PCOST, for the first 20 years. And then around 2000, the first truly electronic exchange started up, which was the ISE. And from then on, it was kind of off to the races. You see that exponential growth through 2005, 2006. The timing was nice. The increased efficiency came as the .com bubble was bursting. A lot of activity, and then things kind of level out around 4 billion contracts a year. And I've been going to these options conferences for a long time, 15, 20 years, and we always used to meet and say, okay, what can we do about boosting volume? And you can see that, in the last couple of bars, which is, the last few years, that volume really does begin to explode. We break out of that 4 billion contracts. The 2018 was the standing record, around 5 billion contracts. That was really helped by the Volmageddon, which happened at the beginning of 2018. And a pretty sharp sell-off at the end of 2018. Then 2019 was kind of back to normal. And then you see 2020, which is off the charts in terms of volume. And then, with over 7.2 billion contracts blowing through the other record by, almost 50%. And then I forecast 2021 volume based on Q1, and I did actually discount it by 10% because if you take the raw numbers, Q1 would forecast 10 billion contracts. I think we'll be closer to 9 billion, but an incredible amount of growth. And we're going to dive into what's going on in some segments. And like I said, I hope our panel has all sorts of awesome perspective on this. So now we're looking at the annual average daily volume broken out by index, ETF, and single stock types. So the shorter line is the index activity, primarily SPX and VIX, relatively stable. Now, SPX is right now a $4,000 index. So in notional terms, it's a lot of dollars, but in volume, relatively stable. The big growth over the last couple of years has been in the ETF space and the single stock. At these conferences, we used to talk about how the ETF business was eating kind of the lunch of the single stock business. And that certainly changed, the way that the last year played out. Incredible growth in the single stock space, and in fact, if you look at the first quarter of this year, we were pushing 28 million contracts a day in single stock option volume, which is an insane amount of volume. That's bigger than the total market volume on an average daily basis for years and years if you just go back a few years. So we're going to dig into kind of why that's happening. I want to do one slide on volatility, just because I do want to point out last year, 2020, was kind of a once-in-a-career type of move in terms of implied volatility and market behavior. We had a new all-time closing high of VIX above 82.5 in March. Realized volatility in the market was towards 100 for a few weeks there. This is a real shakeup, and this is part of kind of the dynamics of things. Is last year really was an outlier. You got to go back to 2008 to find anything even comparable. And people will be kind of looking at this and talking about this for years to come. Order size breakout. Now, the big story about last year really is the single stock activity, and specifically the adoption of using options in the retail space to a large extent. So Now, there's no perfect way to say, okay, gee, how much flow was retail last year? So we use a few different approaches to estimate it. One way I like to do it is just look at the breakout of order of execution size. So you can see on this chart, the bottom section, the two bottom lines are big trades, 1,000 up, 5,000 up. And this is straight up contracts. So average daily volume. So you actually can see last year and even into Q1, the big block, this negotiated institutional block business is actually lower. The smaller trades, 10 lots and down or 100 lots and down, those where all the growth is. So this is really interesting to me because I'm trying to understand. We all see the headlines about Robinhood and these e-brokers dominating, but what's going on in the institutional space, I think, is of big interest to a lot of people that are here, and that's what we're going to talk about. Average order size, or average execution size. So this is another way to kind of try to to take the temperature of small lot trading. I've been collecting option data for 15 years, and there was a couple things were very constant. One was the average order size was around 17 contracts. It had been like that for years and years. Over the last few years, as the retail adoption has picked up, the average order size has just trudged lower and lower to the point where this quarter, basically, we're looking at an average order size of under 7 contracts. This is as the volume is jumping by 50%. So a lot of small orders, a lot more small orders, and there's some implications of that in terms of data loads. And just think about it. If you're putting all of the daily trades in a database like we do, you went from a couple million trades a day to 5 or 6 million trades a day. So that impacts users, and it's a different story. This slide, I have a version of it where I have a little guy with a bow and arrow standing at the end of 2017, which is when Robinhood kind of came on the scene with zero commission options trading. This is single contract trades. Now, this is my simple estimate of retail flow, and I think that some of our panelists have plenty to say about using that as a metric, but just looking at the market share or the straight up volume of these one lot trades, it start to trend up when zero commissions becomes a thing at the end of 2017. But it really picks up. Sorry, I'm going to turn off this light because it's going to keep blinking. It really picks up last year. So to the tune of an extra couple million contracts a day in single contract trades. So, this is a big jump in activity. This to me looks like brand new activity, and this is what we kind of talk about when we talk about, this new flow. And there's a great panel coming up later today, Retail Rising, which will specifically look at this activity. This is participation so OCC publishes breakout by customer firm and market maker on a daily basis. So this is really just a look at the cleared data for volume. And it sums to 200% because you can have 100% customer trading against 100% market maker or firm. You can see a really notable drop-off in the firm participation this year or last year. Through 2020. This is really interesting. Now, in a market share, that kind of makes sense because a lot of the small retail stuff is internalized by a market maker, so it's going to show up in the market maker bucket. But if you look at this, I think the next one is actually on a straight up volume business base. The firm volume is less in the face of this big jump in market activity. So firms trading less, customers trading more is probably the biggest theme of last year. Market structure. This slide hasn't changed in a few years. We have in our market 16 individual exchanges. They're run by 5 operators. They basically each exchange uses has a fee type, whether it's maker taker or payment for order flow in general, and an allocation model for the way trades are broken up. And different order flow providers prefer different models, so each exchange operator kind of wants to make sure they have both bases covered. And then there's innovation in terms of tweaking that model, which is why you have some operators that operate even more than one in each. Market share has changed a little bit over the years. We'll look at that a little bit more in a second. But you can kind of see on the right pie chart, really the breakup of payment for order flow style and maker-taker exchange flow is relatively constant. It barely moves. I've redone that pie chart several times. Never changes. This is the breakout of market share by actual individual exchange. So, and this is mostly just to show, it's with 16 exchanges, and at these conferences, as my panelists know, we would always have a panel about how many exchanges is too many exchanges. Geez, we got another exchange this year, and for a good 5 or 6 years, they were popping up out of the weeds. That's kind of come to rest. We haven't had any new options exchanges in a few years. MIAX starting Emerald was the last one, I believe, a couple of years ago. But you can kind of see from this that it's there's a reasonably active split across the different exchanges, just showing kind of how the competition is pretty dynamic there. This version is by operator, and this is kind of how the exchanges like to look at it, right? So, Cboe has 4 exchanges. How are our 4 exchanges doing in a combined sense? So, and this you can actually see. You can see that the way the last year has gone, really, with this explosion in the multi-list, single stock and ETF business, kind of who's benefited, Cboe specifically because SPX and VIX are such a big piece of Cboe specific exchange volume. That's gotten squeezed a little bit as the retail has really picked up in all the multi-list products. A quick one on liquidity. So this is SPY. I believe it's just for the last year and a quarter. Quoted size and bid offer width in volatility points. So I just really want to point out that March of last year, what that crisis looked like, right? There's other ways you could do this. You could look at this in the entire market or in other products. It's all kind of the same. Size got tiny for about a month there, and markets blew out. Okay, that's the freak out of last March when volatility shot up to 80, at least in the VIX. And then you can kind of see we've come back a decent amount. Market width is close to what it was. The size is not quite what it was. And we'll look at a couple dynamics in that as well. What do we got next? Oh, concentration. So this is always a discussion because there are 4,500 listed products. And for years and years, about 3,500 of them didn't trade. So this last year was a real notable change. So as retail gravitated into options, and you had a lot. I'll show you coming up. A lot of new listings that actually were very liquid underlyings. This has changed. So this is the top 100 names, and the top 100 names do about 70% of the volume nowadays. I think this is Q1. I looked back, and a couple of years ago that was 80%. Meaning that the rest, the other 4,400 listings were making up the difference. So things have broadened out dramatically, and I have a couple more slides on that. And Shelley specifically pointed that out to me in one of our calls before this. I think it's a very healthy move. This is a slide. NYSE gets credit for it because I copied what they had on their page. just looking at the SPY market share versus the others and what the top products are and how much this dynamic with the Reddit style trading has kind of dominated things. So, you can see how much, that SPY nowadays is doing about 10% of the market. It was doing, almost 15-20% of the market for a long, long time. So, even the, to have Apple be in second place, rather than a big liquid ETF like Qs or something is, it's a big development. It changes. It's a very different kind of market dynamic. This is when Shelley Brown gets credit for pointing this one out, because this breadth of activity is a big change. And I ran some data back, and going back about 6 years, you had almost 65% of the listings, the underlyings themselves, trading less than 200 contracts a day. And that's when there were around 4,200 listings. Now there's 4,700 listings, and only 43% of them have average daily volume below 200 contracts. So, like I said before, this is a huge step in the right direction in terms of tradability and liquidity in the single name space, especially for retail. I want to ask the panel about kind of how this does the institutional flow feel that this is the same way from their standpoint. In terms of listings, this is showing the number of actual contracts available to trade. That's the shaded, the area chart, and then the number of listings, underlying listings themselves. So you can see we go really over the last 10 months or so, we go from 4,200 to 4,700 listings. Now we also went up in contracts and peaked around 1.5 million individual strikes. That this is always the strike proliferation is a topic at most of these conferences. It's not a good thing because it's a big data load in terms of a liquidity provider. Keep in mind, think about quoting 1 million changes in real time. The market makers have no choice but to kind of quote a little smaller because they're so spread out. There's risk there. The industry is taking some really nice steps in risk mitigation. We can touch on that, but it also kind of creates a lot of confusion for customers and even for the broker community. If somebody wants to pull up the option chain on SPY, they have 31 expirations, I think, and strikes that go. It's too much to see on a screen. So. What's interesting to me is that this listing, and I asked Jim Hyde about this. Are these 500 new listings? Like, is this a conscious effort to find new listings that are good and get rid of some of the crud? And he told me no. He said, what's happened is the new listing. All these SPACs and ETFs too that have shown up in the last year are very actively traded, and so you have this natural pickup. Let's see. Condition code, I'll be quick on this one. So Opera revamped their condition codes to include better identification of things like auction orders a couple years ago. And so it lets us track how much is executing electronically, how much is executing in the form of auction, which is going to be a lot of that internalized flow. And you can see kind of, the auto, that top line is single leg electronic execution. That kind of dominates the picture. And, but then you have that auction activity around 20% of the volume as well. And then some of the smaller, order types, complex orders, intermarket sweeps, that kind of stuff. Short dated shift. Don't worry, we're almost done. This has been going on for years, really, since weeklies kind of came about. I believe around 2006. The increased adoption in single names has come with this focus on shorter dated contracts. So what you see here is that 6 years ago, only about less than half of the daily volume was in the form of 10-day options and in, or 30-day options and in. And as the weeklies have expanded in what they're listed on, but also as customers have embraced them, you see now easily half the volume in a day is in these short-term contracts. And that's coming at the expense of the longer dated stuff. I think this is something that the industry needs to kind of try to figure out. Because short-dated contracts are great for certain uses, but there's participants that need to trade 2-year options, and we need to pay attention to that liquidity. Another slide on weeklies, just quickly. You can see the green, the blues quarterlies at the bottom. They have kind of a constant use case, especially because they hit a year-end hedge. But the weeklies now make up around 40% of the flow, but it's not equal across names. So you can see it in a very heavily retail name like Apple or Tesla. It can be 60% of the daily volume. Whereas in something a little bit more institutional like SPX or HYG or something, it's 15-20%. So things are not broken out equally. This also goes for, I don't have a slide on it, but I talked about the participation in the firms overall doing less, which is the case. There's certain names which they're still a big part of. HYG is a good example. Firm activity in there tends to be about a third of the volume is trading with firms. So there's a divergence there in terms of where firms are playing. Complex order book activity. This is combined electronic and open outcry. Pretty constant. The green line is the index space, SPX and VIX. You have a lot of rolling. You have a lot of systematic trading there, which means they're rolling and adjusting trades. And then the single stock and ETF complex order flow, about a third, a little bit less than that. And it actually kind of seems like it peaked around 33% and then has kind of come back to more single leg trading. Interesting to see kind of the way March played out last year in all of that crazy volatility, a lot less complex order activity, which I think is kind of interesting. We're almost done, and then we'll get to the panel. Flex options. I love flex options. They're traded on the 4 floor exchanges. So Cboe, Amex, Arca, Philly. They make up about 0.5 to 1% of the average daily volume. These are contracts that customers can pick whatever strike and whatever expiration they want, and they can even kind of trade some exotics now. In some cases, Asian and clique options are permitted. One of the big uses for these are European-style calls, so that customers don't have to worry about dividend exercises. So this continues to see growth. Cboe's investing in it for sure. And this is the only shameless plug I have. That's an option alert window, which is my baby. And we now alert flex trades just like normal trades. It's really they're continuing to advance. And I think they're an important part of the business. And this is the last slide. Participation or institutions. So 13F data provides a look at what institutional filers have options. And what we do is we actually just look at, we do a count here, is show me how many institutions have options on their book. Okay, this is going to be money managers and banks. And how that's growing and how many of those are dropping off, right? So who had options last quarter and didn't have any options this quarter. And we see a nice pattern of growth here. In fact, we're at the highest. This is end of last year because the Q1 deadline's not for a couple more weeks. But you see we're at a high in terms of the total count of participants. You see a lot of new. The green bar is new participants. And you see the biggest drop-off we actually had was after Q1. So you do see how Q1 of last year blew some people out. It was a horrible time to be selling options, basically. But this is healthy and lets us kind of continue to see people moving into the option space. So that's it for these slides, and now we're going to move on to our panel of experts, and they can tell me what I might have gotten wrong. There we are. Howdy, guys. Can you hear me? Can we hear you?
We sure can.
Henry,
all right.
You're asking us what we got wrong? What you
No, what did I get wrong? What did
Okay.
I get wrong in mine?
I was going to say, we didn't even start yet.
If we could go around, I would love to ask you guys what you think are the biggest dynamics going on in the last year and a half, to see if it's get your perspective. So I'll start with Annabelle. We'll go alphabetically.
Sure. Well, so obviously it's a retail story, right? So I'm just going to leave that alone since, I don't deal with the retail space that much. And I think the other two panelists can zoom on that maybe. But, what we see with what we do, which is really, algorithmic execution, it really is the entry of the large multi-strat, funds, right? The 20 to 40 billion-dollar funds that are really getting in the vol space, particularly on the single stock side, really allocating, quite a bit of money to these strategies, right? So they're actively looking for portfolio managers that are knowledgeable in the space. It takes them a few months to really sort of calibrate those sort of, whether it's, relative value, dispersion, sort of strategies. But then when they come in, since they have a large allocation to these strategies, they coming big, right? They're going to trade a lot very broadly, and they're gonna start pumping volume, right? So that's an interesting. So all these guys, come in mostly as professional customers. So they're part of this customer pie that you see growing, right, in your slides. So of course you're going to see, a lot of retail activity, but I think these multi-strat, strategies or funds that are, by the way, not only U.S. There's a lot of U.S.-based ones, but there's also a lot of them that are based in Europe, and we are starting to see some of them in Asia as well. So I think that, from my perspective, they're definitely part of this story.
Cool. All right, Shelley, how about you?
It's certainly interesting times. You spoke earlier about how this move that we saw in the market in early 20 was a once in a career move. The rest of you are obviously far too young to have been around in 87. The big difference, and the thing that really had me concerned coming out of last March and the market sell-off, is if you remember back in 87, after the big sell-off, which, by the way, was much deeper and volatility was a much bigger explosion in the OEX at that time, it took a couple of years for volume to come back. There was a real drought in volume for a long time, from 87, probably past even the mini crash in 89 into the early 90s. We didn't see that this time. And it's a combination of flow from customers and institutions. Henry, you talked a lot earlier about order size, and you can't really equate order size to trade size because of market model. When you have a pro rata exchange and a 10 lot order comes in and there's 10 market makers in the quote, and if they're all 10 up, they're each going to get one lot, and that's going to be shown up on the tape as 10 one lots, when in reality the order was a 10 lot. What we as exchanges don't have insight to is what the parent orders are. So when Annabelle's firm gets an order from an institution and they run their algos on it, they might be doing a VWAP throughout the day or a shorter term VWAP. They could turn a single 100 lot order into a series of 10 lot orders, or even 101 lot orders. And that series of 10 lot orders can be broken up into a series of 1 lot trades. So you can't equate trade size to order size, but certainly the customer volume, you can certainly see the retail volume from the exchange side. It's been great for the business. It's been great for the market makers. You want order flow as a liquidity provider. You want order flow that's buying the offer and selling the bid. So I think it's very healthy for the marketplace, and that has exploded the growth across all the individual equities, not just the ETFs.
Thanks. And Jim, what do you think is the biggest dynamic going on?
I think, as both Annabelle and kind of the slides show, it is the retail story. But I'll just touch on that and quote a couple things from our blog. And thank you for sharing that slide. I think that was indicative of what the universe looks like today. And Shelley, I wasn't there in '87, but in '89, when Rob Bella, founder, and David Beth from Wallach Beth were out in that same XMI crowd, we were fighting on Amex to try to win that flow and get that volume from OEX. So some things never change, I guess, with more on that to come. But it's a great business we're in. It is a retail story, so I'll just touch on a few things on that side first. We've seen, and again, it's evidence in our newest blog, these retail names, and we focused in this particular blog on 4 AMC, BlackBerry, and this is a tongue twister these days, so it's GameStop stock, if I got that right. Brian corrected me earlier today. Names, they've enjoyed an increase of greater than 500% in volume versus just Q 2020. So it's not going back that far, and it is modern times. Also, our data shows that the market quality in those names has exhibited a 45% tightening of the spread and posted liquidity increase, which is quite amazing, of greater than 300%. So if you think about what'd you call it, Volmageddon, and things we've experienced, these names and the trading of these names, you have to credit the whole ecosystem. And that's a perfect segue for me to talk a little about the open outcry piece, which I was asked to cover, and I promise you I'm getting there. But the ecosystem is the market makers. They provide the liquidity. They also have heightened obligations on all floors if they're out there as market maker. If they're specialists, e-specialists, LMM, DMM, whatever they're called, on whatever exchanges they happen to reside, and some of them reside on all. Critical part of the ecosystem. Obviously, the customers feed that ecosystem. As Annabelle alluded to, we clearly enjoy great participation from the institutional side, more on that to come. And the exchanges do their part, and the vendors do their part to support the exchanges and the whole interconnection of all this flow. So hats off to the industry and how we've, gotten to where we have today. But maybe most importantly, I think we do try to learn, as history always will prove, from mistakes. But it's hard to find, especially as it relates, and I'm segueing into open outcry specifically. If you think about the way that the floor businesses are done and that institutional provisioning or that floor facilitation of a trade, through a large firm, a bank, trading with a customer or finding liquidity through an IDB for that same customer. That floor is that point where that large trade probably will reside. But unfortunately, through just something we can't control, which is this pandemic, we've been forced to, or at least that side of the business has been forced to adapt to, and I think they've done a great job, and just service their business differently. And I think on the earlier pre-call, Shelley said something, it's kind of the way to look at floor volume and open outcry, aka manual volume, when you're looking at the numbers, is when you look at the trade size, remember that maybe those trades are actually sliced up differently because they're being serviced differently. So don't get fooled by the trade size numbers or what the data shows. If you look into it, or for any of the floor broker firms, any of the customers feeding those floor broker firms, they understand their business better than anybody who's even touching that trade on any aspect of it. And they'll tell you that, yes, the business is down as it relates to what the floors are seeing, but I think it's still being done. And remember, we're not back at full capacity. At least I'll speak for my two exchanges, ARCA and Amex. But I promise you, we will be back at full capacity, and those trades will gravitate more to the traditional flow of firm facilitation and things like that. And the auction numbers will probably, ease off a little bit. But, the open outcry business, not only is it very important to NYSE, but it's also very important to the ecosystem. So with that, I think a couple slides and questions that we had previously will further detail that.
Yeah, gotcha. Henry, if I may, there's another dynamic here that we should point out, right? And I think since rates are not rising, right, so we are still in the high demand for yield, right? So what you're seeing also is the adoption of vanilla option strategies by the IRA community, and so that needs to be pointed out because that's definitely on the rise, and I think in terms of institutional participation in our listed market, I think you're going to see those IRA adoptions of vanilla option strategies increasing, and that's a very interesting dynamic as well, and very healthy dynamic for the entire industry.
For sure, I know that IRA segment's been a priority for OIC for the participation in the market's tightening. One slide I didn't show, but that when I showed the market maker and customer, and they were kind of both near like 80-90%. If you isolate some of those meme stocks, especially GameStop in January, the customer volume actually went over 100%. Meaning customers were bumping into each other, and market makers were actually kind of stepping back a little bit, which I thought was amazing. Another way you can look at that is the amount of I don't want to get ahead of the retail panel, but the amount of activity versus that's in day trading effectively has exploded, right? So, we've taken friction for some customers down to zero, which is really, really interesting. It doesn't get much better unless somebody's going to write you a check to trade. I think that's, that has some impact. I have, Shelley, I have a question for you. So on the market maker side, do you see that business, the market maker business improving? Do you see more market makers showing up, or a change in who's, like we had a shift, right, from thousands of individual guys on the floors to everybody saying it was dominated by Citadel and a few of the mega market makers. Do you see that pendulum coming back a little bit in favor of some of the smaller, newer firms?
We do see that coming back. We're in a different situation than some of our competitors in that our three exchanges have all been open in the last 10 years. So we don't have the breadth of market makers that the Amex and Arca and Cboe and Philly has. So we've definitely seen an increase in interest in our exchanges from several market makers who have been on Cboe and or Amex and are looking to expand. We've seen a little bit of expansion amongst potential new groups. So there's definitely more interest in market making these days.
So talking about liquidity, Henry, I think there's something that might be of interest for the people watching here, or at least to hear about is that most of these large funds, right, vol funds and multi-strat funds that are looking to get in the vol space, they're also large liquidity providers, right? So by and large, since they had to shift to professional customers in the recent years, right, they will adopt some dynamic posting strategies, and they will actually provide an enormous amount of liquidity to these markets, often responsible to tighten up the spreads. So that's another source of liquidity. Might not be well known out there, but it's prevailing right now.
Gotcha. Yeah, I was going to ask you. I mean, as you know, when you guys are famous for your algorithmic market approach, do you see and obviously the evolution of technology and the markets is making that business more possible? Like, what do you think your customers, or a typical quantitative approach to the options markets? What else would they be looking for in terms of technology or just order types or kind of anything on the exchange side that would facilitate kind of further growth in that?
Right. So they typically try to find the right balance between, So most of these funds, trying to find that right balance between fill rate and not, paying an exorbitant amount in exchange fees, right? So they're going to run strategies that are, basically 60% posting, 40% taking, right? And so they're pretty tactical about this, and they're going to use, algos on the on the taking side that will look just like retail market, retail investors to you, right? Those are mean reverting algos, that will time the execution properly. But, when you look at these execution, they cross the bid ask and it's small lots, right? So that's the taking side. On the posting side, they have an array of different strategies that span from joining the market to turning the market to posting on a dynamic surface to, slightly be more aggressive. Pretty split seems to be the comfort zone for these broad-based strategies. Gotcha.
Do you, Shelley? This one's for you because I think you mentioned something about it. So if I get it that smaller order sizes, fine, it's a mix of customer, and then you've got sophisticated prop, institutional pro, behaving like a customer. So in the end, you got a lot of small orders, electronic eye type of flow, iceberg orders, all this kind of stuff, and less of these big old blocks, which, in the old days we'd call these run-over blocks. Do you think that the market maker community, to me, I guess I would assume that's great because then, nobody has to sell, 2,000 calls, into some sort of a catalyst. Shelley, do you think that that's kind of contributing to the health of the market maker, the profitability of the market maker segment?
Well, I think there's two sides to that. Certainly the small order size, especially when they're crossing the bid-ask spread, is beneficial to the market maker. Having the parent order effectively hidden in the algos takes a lot of information out of the marketplace. One of the beautiful things about the trading floor when we still had trading crowds was you could get a feel for what the order flow was when it came into the crowd. You could tell if it was the Morgan Stanley broker walking into the crowd as opposed to a runner bringing an order to a local floor broker. There was just a whole lot more information in the order flow when we had open outcry and we were in the pits. The electronification of the markets added an opaque feature to that order flow, and now the more the order flow is broken up by the algorithms, the more opaque the actual intent of the end user is. So I'd say it's a double-edged sword.
Gotcha. Yeah, I agree. I think, I've spent, a decade focusing on trying to get information content out of the option order flow. And the game has changed for sure. We are almost out of time. If anybody has anything they want to mention, speak up. Otherwise, we're gonna finish up and move on to whatever comes next, which is Washington. Exciting. All right. Well, thank you guys. All right, everybody, and thank you everybody for watching. And next year,
thank you.
See you in person for sure.
Yes.
Looking forward to it.
Thank you to Henry and his panel. And we also invite you to click into the Washington Outlook session on the agenda page. This session will begin shortly.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.